Hey everybody, welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings in the fourth quarter of 2022, and that stock is Johnson & Johnson. And we can see this stock is down around 2% over the last year, while the rest of the market is down around 7%. So they are outperforming the market at the moment by about 5%. And so we're going to look into some of the recent news that came out surrounding J&J, and then also their financial statements, and figure out the intrinsic value per share for J&J so we can know if this is a good price to buy into the stock from a value investing perspective. And so right here, just to get right out of the gate, this is an article talking about how Johnson & Johnson essentially tried to use an interesting strategy to avoid paying liabilities on a lot of lawsuits that they have filed against their company from different customers that had a bad experience with their products. We can see right here they talk about how they essentially tried to shift a bunch of their shift all of the exposure from their lawsuits, from their liabilities, into a subsidiary, and then file Chapter 11 bankruptcy in that subsidiary so they wouldn't have to pay for the liabilities. And we can see it came out to around 38,000 lawsuits from different plaintiffs, basically claiming that their baby powder and talc products caused cancer. And we can also see right here, if we scroll down, basically the court denied J&J's bankruptcy filing, saying that the company wasn't in financial stress. And as a result, they might have to pay up to $3.5 billion worth of liabilities for these lawsuits as a result. And that ended up causing their shares to close down 3.7%, which was the largest one-day percentage decline they had in 2 years. So definitely interesting to see how this strategy might not be panning out as well for them as they initially anticipated, but they are obviously going to fight this and make the claim that their products don't actually cause cancer, and as a result, maybe they'll be able to save money that way. Also, we can see right here in this article, they talk about the Dow Jones 3 worst performing January stocks, and unfortunately, Johnson & Johnson was down 7.5% in January, so it was one of the worst performing stocks. One of the main reasons was because they cut production of their COVID-19 vaccine due to weak demand, and they also cut production of one of their drugs because it was not effective in preventing HIV infection. On top of that, if we scroll down here, they point out that there was 4% revenue growth in 2023, excluding the impact of the COVID-19 vaccine. So if you didn't include the fact that they cut production of the vaccination, then their business revenues and sales were actually up 4%. And then they also point out here the same thing as we pointed out in the last article, that because of these talc lawsuits, the 38,000 lawsuits from plaintiffs that were rejected by the court, the bankruptcy court, for them to try to basically slide past not paying these liabilities, they might potentially have to pay up to $10 billion, which most analysts deem manageable considering how gigantic their company is, but it is still going to be a hit to their expenses and their bottom line net income. And so right here we can see their first financial statement, their balance sheet. We can see from 2021 to 2022 here, they're comparing their full annual year results. Their total assets are up from $182 billion to $187 billion. We can also see that shareholders' equity is up around $2 billion, and the total retained earnings line item is up about $5 billion. So they do have more capital here to reinvest into the company and distribute to shareholders. And then right here on page 47, we can see their income statement. They're comparing their annual results here. For 2022, they had total sales of $94 billion, and of the fourth quarter, they only had around $23.7 billion, and that was down around 4% year over year from $24.8 billion in the fourth quarter of 2021 due to them cutting their vaccine sales, like we pointed out in the article. And then also net earnings for the full year came out to be $17.9 billion, down from $20.8 billion, and this was down actually 25% year over year for the fourth quarter, from $4.7 billion in 2021 for the fourth quarter down to $3.5 billion for the fourth quarter of 2022. And then lastly right here, we can see their cash flow statement for the full year of 2022 to 2020. During that time period, operating cash flow decreased from around $23 billion in 2021 to $21 billion in 2022. And we can see they've been returning a ton of value back to shareholders, considering the fact that they only had operating cash flow of around $21 billion, but they returned close to $18 billion worth of cash back to shareholders through $11 billion in dividends and $6 billion in repurchases of common stock. So definitely a lot of value returned to shareholders, which is a good sign. That's probably one of the reasons why their stock outperformed the S&P 500 this year, even though they were still down yearly by about 2%. And so now we have this discounted cash flow model to try to figure out the intrinsic value per share for J&J. Yahoo Finance is estimating that they're going to grow at around 4% for the next 5 years. So I cut that in half to 1.5% to be a little conservative with my estimate. They had around $17 billion worth of free cash flow in 2021 or 2022. And they had around $17.4 billion worth of debt on their balance sheet and 2.6 billion shares outstanding. And so that puts their intrinsic value per share at around $71 per share, which means at the moment they are not trading below intrinsic value per share. Since they're trading at $155 per share, they would basically have to fall to half the current price in order to trade at this estimated intrinsic value per share based on these growth rates of around 3 to 1% per year. Then on the right-hand side here, I did a competitor analysis comparing them to two of their main competitors, Procter & Gamble and Bristol Myers Squibb. And we can see that gross profit margin is higher than their two competitors, as well as net profit margin. Procter & Gamble has the highest return on assets. And we can see they're trading at the lowest PE ratio relative to their earnings. And then they also pay out the highest dividends. So from a competitor analysis, they're pretty much beating out their two competitors in every area here besides return on assets. So from a competitor analysis perspective, I would probably choose Johnson & Johnson over Procter & Gamble and Bristol Myers Squibb. And then lastly right here, I'm comparing them to the past 6 companies that we reviewed for the last 6 videos I did. And we can see that in terms of intrinsic value per share, the video we made about Albertsons is still holding the top spot. It's currently the only stock on our list that's actually trading below intrinsic value. It was trading at around 45% of its intrinsic value per share. Johnson & Johnson is unfortunately basically trading at more than double their current intrinsic value per share because it's $71 and their share price is $155 per share. So not doing too good. That puts them at about 5th place on the intrinsic value list, right ahead of Nike, but lagging behind Microsoft. In terms of growth rate, J&J had the lowest at 3%. Gross profitability, we can see that they actually came in 3rd place for gross and net profitability, 67% right behind Microsoft, ahead of Nike, and then 18% right behind Adobe and ahead of Netflix. And then lastly, on the right-hand side here, in terms of stock performance, they're doing the worst on our list so far. Microsoft is still holding the number 1 spot at 191% stock growth over the last 5 years. For Johnson & Johnson, it only comes out to 17% stock growth over the last 5 years, which means that since the S&P 500 is up around 45% over the last 5 years, we can see Netflix, Albertsons, and Johnson & Johnson are actually not doing as good as the S&P 500 over the last 5 years. There might be a little case to make an exception for Albertsons since they actually haven't been public for 5 years. They've only been public since 2020. So you might be able to give Albertsons a slide here, but definitely for Netflix and Johnson & Johnson, they are underperforming the market over the 5-year chart. So in terms of ranking them across these last 7 companies we've looked at, looks like J&J is not doing as well as the other companies. Obviously, these are coming from different industries, so they are going to have different ratios here. But if we want to pick a company that we're going to invest in, based on this list, it's probably not the choice that I would go for. In terms of a competitor analysis perspective, comparing them against the companies that are actually in their industry, they are doing very good in terms of financial ratios. So you would probably want to pick Johnson & Johnson ahead of Procter & Gamble and Bristol Myers. But from just an intrinsic value standpoint, comparing them against their own financial statements, it looks like they are not trading below intrinsic value per share at the moment. You would want their share price to potentially come down a little bit from where they're currently trading at. So for me personally, Johnson & Johnson is definitely an interesting stock. They're one of the biggest companies in the stock market, so I'll be keeping my eye on it. but I probably wouldn't invest in it at the current share price for me personally. That doesn't mean that it's a bad investment, but for my personal parameters, it probably wouldn't be something that I would go for. But let me know in the comment section down below why some of you guys might want to invest in J&J, or if you guys think it's a buy or a sell right now. Let me know what you guys think in the comment section. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.